Okay, we are recording. Hello there, everybody. I am doing this recorded lecture to go over problem 11-2B. You guys have 11-2A for your homework, so this will give you an example of it. And hopefully it looks familiar to you. We got a lot of practice with these worksheets in Principles of Accounting 1 last semester. So it's more of the same, just we've got that merchandise inventory adjusting entry. And then some of the accounts that we didn't deal with before, like purchases and sales returns and allowances and that kind of thing. But the overall function of the worksheet is similar. So hopefully it's okay with us, but let's get to it. I am going to share my screen with you and get this Excel file pulled up. So this is the Excel file for this worksheet. And this is, again, problem 11-2B, Palengo furniture. So we've got our beginning balances here, which they give us, right? That's our trial balance, essentially the unadjusted trial balance. And so we just need to go through, do our adjusting entries, and then update the worksheet like we've done together before. So I've typed in our adjusting entries here. They're highlighted in yellow so we could go through and get practice with these together. So the first one is that merchandise inventory adjusting entry. So merchandise inventory at December 31 is 104,565. So remember, that's what we want our balance to be. And so the first thing we need to do is zero out or close out what we had before, or what we had to begin with. So if we scroll back up here, here's our beginning inventory. So we need to close this one out first, and then we can record the correct amount. So 118,628 is what we need to do our first entry for. So we debit income. Hot dog. We debit. Oh, why it's putting it in red. Oh, well, it doesn't matter. We debit income summary. I already forgot the darn amount. 118,628. We credit merchandise inventory. Uh, 118,628. Okay, so that's zeroing out or closing out that beginning balance. Now we can record the actual amount. And this is the actual amount that they give us here, right? 104,565. So we debit merchandise inventory. $104,565. We credit income summary. 104,565 is what that one would look like. Okay, so we've taken care of A and B. The next one, wages accrued, 934. So again, this is a situation where the employees have worked, they have earned the wages, they just haven't been paid yet. So we need to accrue that salary and wage expense. So we need to debit wage expense for 934, credit wages payable. 934 is what that one would look like. Okay. Store supplies inventory on hand, 755. Okay, so we need to scroll back up and see, what did we have to begin with? If we look at our supplies account here, we had 1,850. So to figure out how much we used, we take our 1,850 minus 755 is what we have left. So we used, oh, hot dog. So we used what? 1,850 minus 755. We used 1,095. That's what we need to do our adjusting entry for. So we need to debit supplies expense, 1,095, credit the supplies asset account. 1,095. Okay, so we've got this one taken care of. The next two are depreciation. Letter E is depreciation of the store equipment. Letter F is depreciation of the office equipment. Similar entries, debit depreciation expense for store equipment first. 49.82. Credit accumulated depreciation for the store equipment. 49.82. And again, letter F is also a depreciation entry, but it's for the office equipment. So very similar. We debit depreciation expense for office equipment. 1531. We credit accumulated depreciation office equipment. 1531. Okay, so we've got both of those taken care of. Letter G, insurance expired during the year 935. So they're giving us the amount that we need. We don't need to calculate anything. We always do our insurance adjusting entry for the amount that has expired or been used up. So we debit insurance expense 935. We credit prepaid insurance 935. All right, so we've got that one taken care of. And then lastly, rent earned 2,450. So if we scroll up here, we've got this unearned rent here, 3,150, right? And so apparently, these tenants, the people renting from us, paid us rent in advance. Well, now they've occupied the space. And so we have earned some of that, right? We saw an example of this together in class on Wednesday. So when we do this adjusting entry, we just need to debit unearned rent revenue for 2,450, the amount we've earned, and credit rent revenue. So we're just moving it out of that unearned rent revenue liability account into now we have earned it rent revenue account, right? Okay, so that's what our adjusting entries look like. We've done these together now several times, so hopefully looking good to you. Now we just need to go through and update the worksheet with the adjusting entries. So the first one, and I'm going to kind of zoom in on this a little so it's bigger for us. So the first one was to this inventory account. Letter A, we zeroed out this inventory account. So if we look back here, the entry is debit income summary, credit merchandise inventory. So if we look here at our accounts, we do not have income summary here. So we just need to type it in like we've done before. So we're going to have income summary. And this is letter A. And this is the one where we closed out that beginning balance. So we're going to debit income summary 118,628. And then we're going to credit, here's that merchandise inventory. This is letter A. We're going to credit merchandise inventory 118,628. So that would zero out that beginning balance in inventory, right? So we've just done or posted letter A. Now we need to do letter B. So letter B, we're going to debit merchandise inventory to record the correct amount, 104,565. So we scroll back up here. We're going to have a debit. This is letter B, 104,565. Credit income summary, 104,565. Okay, so those are the two inventory entries, the debit and the credit. Okay, the next one is for this accrued wages. So we need to debit wage expense for 934. See if I can blow this up a little bit more for us. Okay, so we do have this wage expense account already here. So we just need to debit an additional 934. But if we look in our liabilities here, we got note payable, accounts payable, unearned rent. We don't have wages payable, so we need to type this one in. Wages payable. This is a credit, 934. Okay, there is that one. The next one is this supplies adjusting entry. So we need to debit supplies expense for 1,095. Again, if we look here in our expenses, we don't have supplies expense yet, so we just need to type it in. Sipples, supplies expense. And this is letter D, 1,095, right? Let me scroll back down and double check. Yeah. And then credit. We do have that supplies asset account, credit supplies asset account 1,095. Okay, so we've got that one. Now we've got our depreciation entries. So depreciation expense on the store equipment, 4982. Okay, if we look here at our expenses, again, we do not have depreciation expense. So we just need to type it in. This is letter E, 4982. We do, however, though, have the accumulated depreciation store equipment account already there. So then we need to credit accumulated depreciation 4982. Okay, let's scroll back down here. So we've got that one. Now we need to do the same thing for office equipment. So we need to debit depreciation expense for the office equipment, 1,531. This is not already an expense. We just need to type it in. Depreciation expense, office equipment. This is letter F, 1,531. We do, however, already have that accumulated depreciation account for the office equipment. So letter F, 1,531. Okay, so we've got both of those. Next is our insurance expense adjusting entry. So we need to debit insurance expense for 935. Again, if we look here at our expenses, we don't already have it. We just need to type it in. Insurance expense. This is letter G for 935. We do already have the prepaid insurance account up here though. So we need to credit prepaid insurance 935. And then lastly is the rent revenue, unearned rent revenue adjusting entry. So we need to debit unearned rent revenue for 2,450. If we scroll up here, we've got this unearned rent revenue account. So we need to debit it, 2,450. We do not, however, so here's like our sales revenue. We don't have that rent revenue account already though. So we just need to type it in, rent revenue. This is letter H, 2,450. Okay. So now we've got our adjusting entries, all of our adjusting entries posted to the worksheet. So, now, and we can see here that on our adjustments, debits equal credits, so that's good. That means that we have recorded equal amounts of debits, equal amounts of credits. So that's kind of the first check that we have. And so now what we need to do is go through, and I'm just going to start at the top and go line by line, wherever the accounts belong. So if the accounts belong on the balance sheet, they go on the balance sheet. If the accounts belong on the income statement, they go on the income statement. And just to remind us, our income statement accounts are the revenue and expense accounts. The balance sheet accounts are the assets, liabilities, and equity. Hopefully we remember that from last time that we did these worksheets. So I'm going to blow this up, and then we'll just go through again line by line. So cash is an asset. Cash belongs on the balance sheet, and cash did not have any adjustments. So cash is still 12,482. Okay, accounts receivable also did not have any adjustments. Accounts receivable still 38,962. Okay, merchandise inventory did have an adjustment. So again, this was the beginning balance, 118,628, right? That was the beginning balance. And we zeroed that out with this credit. So there was a debit of 118,628. We credited 118,628. So these two canceled each other out. And so what we need to carry over is this actual amount. So equals our 104,565. That's what goes on. That's what will be on the balance sheet, the correct or actual amount. Okay, supplies did have an adjustment. So supplies had a debit balance of 1,850. We credited or subtracted 1,095. So supplies is down to 755. Okay, prepaid insurance also had an adjustment. Prepaid insurance had a debit balance of 2,488. We credited or subtracted 935. Prepaid insurance is now down to 1,553. Store equipment, there was no direct adjustment to store equipment, so it's still on our books at that original cost, 32,824. Remember, we adjust the book value through accumulated depreciation. Accumulated depreciation has a normal credit balance, so it had a credit balance to begin with of 26,420. We credited or added another 4982. That's up to a credit balance of 31,402. Office equipment, again, no direct adjustment to these fixed asset accounts, so still 11,236. We adjust their book value through accumulated depreciation, which did have an adjustment. So normal credit balance, it started at a credit of 3410. We added or credited another 1531. So we're up to 4941 now there. So notes payable did not have an adjustment. Accounts payable did not have an adjustment. So these just get carried over. So notes payable still equal to 6,000. Accounts payable still equal to 23,420. Unearned rent, however, did have an adjustment. So unearned rent, again, this is a liability account. Liabilities have a normal credit balance. It started with a credit balance of 3,150. We debited or subtracted 2,450. So we're down to 700 in there now, in that unearned rent account. Okay. Owner capital did not have any direct adjustments. Owner drawing, no direct adjustments. So we're just moving those over. So capital still 125.32. Drawings still 28,000. Okay, now these next accounts, next few accounts or several accounts, sales returns and allowances, purchases, purchase returns and allowances, purchase discounts, freight in, wage expense, interest expense, income summary. These are all income statement accounts. So now we're looking at our income statement columns. So sales, no adjustments, still 647,090. Sales returns and allowances, no direct adjustments, still 8848. Purchases, no direct adjustments, still 519,374. Purchase returns and allowances, no adjustments, still 12,440. Purchase discounts, no adjustments, still 8634. Freight in, no adjustments, still 22,824. Wage expense, though, did have an adjustment. So wage expense started with a debit balance of 52,800. We debited or added another 934, so wage expense up to 53,734. Interest expense, no adjustment. Okay, now we're down to these accounts that we used for our adjusting entries. So income summary had a debit of 118,628, a credit of 104,565. Wages payable. This wages payable belongs on the balance sheet. Remember, wages payable is a liability. Credit balance of 934. The rest of these all belong on the income statement. So supplies expense had an adjustment for 1,095. Depreciation expense on the store equipment had an adjustment of 4,982. Depreciation expense on the office equipment adjustment of 1,531. Insurance expense adjustment of 935. And then lastly, this rent revenue. And remember, revenue has a credit balance, so it goes in the credit column, had an adjustment of 2,450. So that takes our, and let me delete this. And so to remind us of how we get it. So remember, let me scroll out so we can see this whole thing. So remember on our income statement, the credit column represents revenue or items that increase our net income, right? Debits represent expenses or items that decrease our net income. So remember the formula overall to get net income is revenue minus expenses equals net income. So again, to get this amount, we're going to say equals our total credits, which represent revenue type transactions that increase net income, minus expenses or transactions that decrease net income, right? So we've got a check figure, 42,448. If we look in the book, that is our check figure for net income in the book. So we know we're on the right track. And that should also be the difference between debits and credits. So remember that debits and credits on the balance sheet. So remember that net income flows to the statement of owner's equity, which then flows to the balance sheet in the equity section of the balance sheet. So to double check this, we can say, okay, equals our debits minus our credits, 42,448. Okay, good. And these two equal like they should. Because again, that net income would end up flowing to our balance sheet First we prepare the statement of net income, we figure out net income or income statement rather. We figure out net income that flows to our statement of owner's equity. We figure out the ending balance in owner's equity, and that flows to our balance sheet. So anyway, that is problem 11-2B. You guys are going to be doing the same thing for 11-2A. So hopefully that was helpful, and we will get more practice with this together next week. Anyway, you guys have a good rest of your day, and you know where to find me if you have any questions. Bye-bye. Bye-bye.